And we're also watching some weak economic data, and that's not doing much to help sentiment. We had consumer confidence posting its biggest monthly drop since 1973. And we also had the Richmond Fed survey out today, and it showed a huge crash in April. And this comes as economic activity plunges at an unprecedented speed. So for more on this and for more on today's market moves, I want to bring in Jeff Schulze, investment strategist at ClearBridge Investments. And Jeff, help me make sense of what's going on in the market today. Because like I said, the Dow was up well over 300 points, almost up 400 points at the high. Right now, we're barely holding on to positive territory. What are investors paying closest attention to today?
Well, I think obviously the markets are trying to continue the positive price action that we saw overseas, but the stark reality of some of the grim economic data that's going to happen here in May is front and center, obviously, with the big drop of consumer confidence and the Richmond Fed as well. But also, I think it's time for the market to take a little bit of a breather because, well, the market's not exactly trading cheap right now. If you look at 2020 expected earnings, the market multiple right now is at 21.2. And then if you look at 2021 earnings, a year and a half out from now, the market multiple is still elevated at 17 times, which is above the long-term average. So after a robust rally, after the lows that we posted back on March 23rd, I think the market's just reassessing valuations and whether it can continue to move forward.
Jeff, do you think the market can continue to move forward? Because what you're saying right now is it sounds like you think that the market is pricing in a lot of optimism at these current levels.
Yeah, it is. The market certainly could continue to move forward as you have about a ton of money on the sidelines. From a cash balance perspective, there's over $4 trillion sitting out there. Also, positioning is offsides. A lot of investors may get a little bit of FOMO. If you look at short interest in the S&P 500 or hedge funds, they're net short right now. So it certainly could go higher in the near term. But I think as the economy starts to reopen, you're starting to see states like Georgia reopening and now Texas this week. I think the slow pace of reopening could make markets reassess whether or not they've gotten ahead of themselves at this point, because I think consumer and business behavior is going to be changed fundamentally. And also you have that risk of a second wave. So I think it could move higher in the near term, but I think we're pretty full from a valuation perspective.
Jeff, what do you think of the earnings that we've gotten out so far? Because when we take a look at EPS revenue and a lot of the data that we're getting from these companies, it's backward looking. A lot of these companies have scrapped their guidance, and that's specifically what investors historically pay closest attention to here. So how do you think investors are reading these numbers, or how should they be looking at this earnings season?
Yeah, I think they need to look through this earnings season. We're flying blind here. Over 100 companies in the S&P 500 have removed guidance. Obviously, if you're a company, you're going to throw in a lot of negativity into this quarter, the proverbial throwing the kitchen sink in. So I think at this point, investors just really need to reassess what the recovery is going to look like on the other side without the help of corporate managers in this earnings season. So unfortunately, I think that they're going to get a mulligan for this earnings season, maybe next earnings season, and it's really only going to start to matter when we get to Q3.
Jeff, with no guidance and when we're trying to gauge different investment opportunities, what are you telling your clients to pay the most attention to?
I think obviously we need to pay attention to the economic data, but we're going to see the worst economic data on record for pretty much every indicator for the month of May when we get the April numbers. So it's something we need to monitor, but you also want to look at jobless claims. And one of the reasons why we've been advocating caution to our clients is because coming into this situation, our recession risk dashboard was flashing a cautionary yellow signal because profit margins were under pressure for the broad U.S. economy. Profit margins for the economy have been flat since 2016, and it's disproportionately hurt micro and small cap businesses. Now, importantly, a lot of businesses are starting to shed workers, and not just the ones that have been affected by these shutdowns. A survey that just came out recently by the NBER, it looked at 5,500 small businesses, and out of those small businesses that did not shut down, the ones that remain open, they cut their full-time employees by 17.5% and their part-time employees by 36%. So when we get to the other side of this storm, you're going to continue to have a joblessness situation, an overhang in the labor market, and more importantly, an overhang on consumer spending. But the number one data point that I'm looking at right now is jobless claims and whether or not that can continue to come down.
Jeff, what do you think, if you had to pick sectors here that you expect to lead us out of this recession, what sectors do you think that would be?
Yeah, so since this recession is not going to look like any other recession that we've had, it's going to be more of a U-shaped recovery. I think the leaders that we've seen coming out of the bottom are going to continue to be the leaders going forward. I think tech is very well positioned for this type of environment. And the fact that the 10-year treasury and rates are going to be lower for longer is really going to be a boon for IT companies. I also think healthcare is going to be a darling. Obviously, healthcare has one of the strongest balance sheets. They tend to be economically bulletproof, but also that whole sector is getting a lift for the potential of finding a cure for COVID-19. Also, political risks have receded in that sector, with Joe Biden now getting the nomination for the Democratic nominee. And the other area is we're going to be looking at select parts of comm services and consumer discretionary, but it's going to be a stock pickers market. There's going to be a lot of dispersion. You're really going to want to know specific companies rather than broad swaths of those sectors.
Jeff, speaking of earnings, we're going to get the results from a lot of these big tech companies starting tonight and then over the next couple of days. And it's interesting when you take a look at these tech companies because a fifth of the S&P 500's market cap is accounted for by 5 big tech firms. What do you think the implications are for this when it comes to the broader market?
This has huge implications, right? If you look at the breadth of the market from the lows that we've seen, it's been very narrow. And it's a key reason because a lot of money has been funneling to these 5 large internet IT companies, even though they're all not in the IT sector right now. And if you do see some disappointment from a couple of these players, that could be a key reason why you see the markets move down, a little bit of profit taking as we move into later part of the earnings season. But this is a critical season, and it's very rare for the 5 largest constituents of the S&P 500 to release their earnings data on the same week.
All right, Jeff Schulze of ClearBridge Investments. Thanks so much for joining the show today.
My pleasure. Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.